3 days ago, something happened in the silver market that almost nobody noticed. No breaking news alerts, no headlines on Bloomberg, no loud reactions on television. But the people who watched the physical market closely saw it immediately. And when they saw it, they understood one thing. The rules may have just changed. Because for the first time in this entire cycle, silver started showing early signs of backwardation. And if you do not know what that means yet, stay with me. Because by the end of this video, you will understand why this single signal has historically appeared right before some of the biggest silver moves ever recorded. Right now, as you are watching this, silver futures for immediate delivery are quietly trading at levels that are beginning to challenge the prices of silver contracts months into the future. That might sound technical. It might sound like something only traders care about, but it is not. This is the market sending a message. And the message is simple. The demand for silver today is becoming more urgent than the promise of silver tomorrow. Let that sink in, because under normal conditions, the future is always more expensive. That is how commodities work. Storage costs money, insurance costs money, time has value. So normally silver next month trades higher than silver today, always. That is the natural order of the market. But when that order starts to break, when present demand becomes so intense that buyers are willing to pay more now than later, the structure flips. And that flip has a name: backwardation. This is not theory. This is not opinion. This is market structure. And it only appears when something deeper is happening beneath the surface. Let me explain it in a way that makes complete sense. Imagine a water tank that supplies an entire city. Normally, the tank is full. People take water when they need it. There is no panic. There is no urgency. But one day, people begin to worry that the tank is not refilling fast enough. Suddenly, everyone wants water immediately. Not tomorrow, not next week. The value of immediate access rises. The promise of future water becomes less valuable than the water available right now. That is backwardation. And that is exactly what silver is starting to signal. Over the past week, the spread between spot silver and near-term futures has narrowed aggressively. This is not random. This is not noise. This is the result of physical demand pressing against the paper structure that normally controls price perception. And this pressure is not coming from small traders. It is coming from the largest participants in the market: industrial buyers, institutions, entities that do not care about paper profits. They care about securing physical supply. Now ask yourself a simple question. Why would anyone be willing to pay more for silver today instead of waiting a few months, unless they believed waiting carried risk? Because that is the real meaning of backwardation. It is not about price. It is about urgency. It is about trust. It is about the market quietly admitting that the future availability of supply is less certain than it appears. And here's the part that should really make you pay attention. The last time silver entered a sustained backwardation environment, the price did not stay calm. It did not move slowly. It moved violently. Because once the physical market starts pulling harder than the paper market can suppress, the balance shifts. And when that balance shifts, the price follows. Right now, most people looking at silver see only the number on their screen. They see $85, $86, maybe $87. They see small moves, normal moves, nothing dramatic. But the real signal is not the price. The real signal is the structure underneath the price, because structure always changes before price does. And the structure is starting to change. What makes this moment even more important is the timing. This is happening while silver inventories inside major exchanges are not increasing in any meaningful way. No surge of new metal entering vaults. No sign of abundant surplus supply rushing in to relieve pressure. Instead, the opposite. Quiet tightening, quiet strain. Quiet signals that the physical side of the market is not as comfortable as the paper side. Suggests this is how transitions begin, quietly, invisibly, until suddenly they are not quiet anymore. Most people will ignore this signal. They always do, because backwardation does not make headlines. It does not create viral clips. It does not create instant panic. It is subtle. It is technical. It requires understanding. But the ones who understand it know exactly why it matters, because backwardation is not just a signal. It is a warning. And in the next part, I'm going to show you exactly what is happening inside the silver vault system right now, the numbers that explain why this pressure is building, and why the physical market may be moving toward a moment that the paper system cannot easily control. If backwardation is the warning, then the vault data is the evidence, because signals do not appear without cause, structure does not change without pressure. And right now, the pressure inside the physical silver system is coming from one place: inventory. More specifically, the lack of meaningful inventory growth at the exact moment when demand is accelerating. Let me explain what that means clearly. Inside the silver market, there are two categories of metal that matter more than anything else: eligible silver and registered silver. Eligible silver is metal that exists inside vaults, but is not currently committed for delivery. Registered silver is different. Registered silver is the metal that is actually available to fulfill delivery obligations on futures contracts. This is the silver that can legally change hands when someone holding a contract decides they want the physical metal instead of cash. And this is where things start to get interesting, because over the past several weeks, the amount of registered silver has not been rising in a way that reflects the growing interest in the market. In a healthy system, when prices rise and demand rises, new supply flows into vaults. Producers deliver more, sellers step forward, inventories expand. That is how balance is maintained, but that is not what we are seeing right now. Instead, what we are seeing is stagnation. The registered category is holding at levels that, when compared to the total amount of paper silver contracts in existence, look increasingly thin. To put this into perspective, the open interest in silver futures represents hundreds of millions of ounces of silver, but the amount of metal actually sitting in the registered category available for delivery is only a fraction of that number. This does not mean every contract holder will demand delivery. Most never do, but that is not the point. The point is that the safety margin is smaller than it appears on the surface. And when safety margins shrink, markets become sensitive to demand spikes, sensitive to supply interruptions, sensitive to fear, and fear is what creates urgency. At the same time, something else has been happening that most people have missed completely. Physical premiums in key regions have not been falling, they have been holding firm, in some cases, quietly rising. This tells you that buyers who want real metal are still willing to pay above paper prices to secure it. And that is one of the earliest signs that the paper price is no longer perfectly aligned with physical reality. Because paper can expand infinitely, physical cannot. Every ounce of real silver has to be mined, refined, transported, and delivered. It cannot be created with a keyboard, it cannot be printed into existence, and when demand for physical silver increases faster than supply can respond, the system absorbs the pressure until it reaches a point where something has to adjust. Usually that adjustment is price, but before price adjusts, structure adjusts first. That is exactly what backwardation represents. It is the structure bending under pressure before price fully reflects that pressure. Now think about this logically. If silver were truly abundant right now, if supply were comfortably exceeding demand, the market would show it. Futures prices would sit calmly above spot prices. Vault inventories would rise steadily, physical premiums would fall, urgency would disappear, but instead, we are seeing the opposite pattern beginning to form. Spot prices strengthening relative to futures, vault inventories not expanding aggressively, physical premiums refusing to collapse. These are not random events, these are connected signals, and there is another layer to this that makes the situation even more important. Industrial demand for silver has not slowed down. Solar production continues to expand. Electronics manufacturing continues to consume silver at massive scale. Advanced technology systems depend on silver's conduct, medical equipment, energy infrastructure, defense systems, all of it depends on silver. This is not speculative demand, this is structural demand, and structural demand does not disappear because price becomes inconvenient. It adapts, it competes, it pushes harder. Which brings us back to the central question: if physical demand continues pressing against a limited supply buffer, and if futures structure continues tightening toward backwardation, what happens when a larger wave of delivery demand enters the system? Because markets can ignore pressure for a while, but not forever. And in the next part, I'm going to show you something even more important: the role of large institutional players and why their behavior right now suggests they are positioning for a scenario that most retail investors are not prepared for yet. What makes the situation even more serious is not just the inventory levels or the future structure, it is who is acting behind the scenes. Because markets are not moved by headlines, they are moved by positioning. And right now, some of the largest players in the silver market are behaving very differently than they were just a few months ago. Over the past several sessions, large institutional traders have been adjusting their exposure in a way that suggests one thing: they are becoming more cautious about being short silver, and that matters more than most people realize. To understand why, you need to understand how the silver market normally functions. Large banks and institutional traders often take the short side of futures contracts. This is part of the system. They provide liquidity. They create the paper structure that allows the market to operate smoothly. Most of the time, this works without issue because physical demand and paper supply remain balanced enough to prevent stress. But when physical demand starts increasing faster than expected, the short side becomes more dangerous because every short contract represents an obligation to deliver silver if required, or an obligation to buy back the contract if delivery is not possible. And when too many shorts try to exit at the same time, price can move very quickly. That is why positioning changes matter. Recently, data has shown that the aggressive expansion of short exposure has slowed. In some cases, short positions have even begun to reduce. This does not mean the market is about to explode tomorrow, but it does mean the confidence that existed earlier in the cycle is no longer as strong as it was. This is how transitions begin: quiet reductions, quiet repositioning, quiet preparation, because the largest players in the market do not wait for headlines. They act before headlines appear. At the same time, another signal has been flashing in the options market. Volatility expectations for silver have been rising. This is extremely important because options markets do not react to emotion, they react to probability. When implied volatility increases, it means traders are preparing for larger price swings, not small moves, but large moves. And this increase in volatility expectations is happening while silver is still trading within what appears to be a controlled range. This creates a disconnect between price stability and volatility expectation. That disconnect cannot last forever. Eventually, price resolves in the direction volatility is preparing for. And this brings us back to backwardation. Backwardation and rising volatility together form a powerful combination because backwardation reflects physical urgency and rising volatility reflects financial uncertainty. When physical urgency and financial uncertainty appear at the same time, markets become unstable. Not immediately, but inevitably. There's another piece of this puzzle that deserves attention: the behavior of long-term holders. Instead of rushing to sell silver as prices rise, many long-term holders have remained unusually patient. This reduces available supply in the open market, and it creates a tighter environment. And it increases the sensitivity of price to new demand, because when fewer people are willing to sell, buyers must compete harder. Competition increases price pressure. This is basic supply and demand. But when this dynamic occurs inside a future system built on leverage, the effect can multiply. Small physical imbalances can create large financial consequences. This is exactly why backwardation is taken so seriously by professionals who understand commodity cycles, because backwardation is not just a price event, it is a structural imbalance signal, and structural imbalance signals do not appear without reason. Right now, silver is not exploding higher, it is not collapsing lower, it is doing something far more important. It is compressing inside a tightening structure, compressing while physical demand remains firm, compressing while volatility expectations rise, compressing while large players quietly reposition. Compression is not the end of a move. Compression is the preparation phase before a move. And in the next part, I'm going to explain exactly what happens historically when silver enters this type of compression while backwardation signals begin appearing. Because the history of this pattern tells a story that very few people are paying attention to right now. History has a pattern. Not an exact script, not something that repeats perfectly, but a pattern that leaves clues. And when you study silver long enough, you begin to notice something very specific. Backwardation almost never appears during calm, stable, low-interest environments. It appears during transition phases. It appears when the balance between physical supply and financial supply starts to shift. One of the clearest examples happened during the last major silver expansion cycle. Before silver made its explosive move higher, the first signal was not price. It was structure. Futures spreads began tightening, spot demand strengthened, physical supply became harder to secure at paper prices. At the time, most people ignored it. They focused on daily price fluctuations. They did not see what was happening underneath, and then suddenly price began to move, not slowly, violently, because once the paper market could no longer comfortably suppress the pressure from physical demand, price had to adjust upward to restore balance. That is how commodity markets resolve imbalance. Not by negotiation, by repricing. And that is the key word, repricing, because silver is not like stocks. It is not valued based on earnings reports or company performance. It is valued based on physical availability and demand. When availability becomes uncertain, price becomes unstable. This is why backwardation is so important. It is one of the few signals that comes directly from the physical side of the market. It cannot be manufactured easily. It cannot be faked consistently. It appears when real buyers compete for real metal. Right now, we are not in full backwardation across the entire curve, but early signs are appearing in specific contracts, specific time frames, specific spreads. And historically, this is how it begins. Not everywhere at once, but somewhere first, then gradually expanding. Another historical example came during periods of supply disruption. When mining output slowed or delivery chains tightened, future spreads reacted before price did, the futures curve flattened, and spot demand strengthened. And eventually, price followed, because the futures market cannot ignore physical reality forever. It can delay it and it can smooth it, but it cannot eliminate it. There is something else that happens during these periods that most people do not notice until it is too late. Sentiment remains divided. Some analysts call it nothing, some dismiss it. Some claim it will resolve quietly. This creates hesitation, and hesitation keeps price contained temporarily, but containment does not mean resolution, so it means pressure continues building. Think of it like a sealed container. Pressure can increase inside without any visible change outside until eventually the container cannot hold it anymore. Then the release happens quickly. This is why experienced commodity traders watch structure more closely than price, because structure reveals pressure, price only reveals reaction. Right now, the reaction has not fully happened, but the pressure signals are starting to appear. Another important piece of the historical pattern is volatility expansion after compression. Silver has a long history of trading quietly before entering periods of extreme movement, long periods of calm followed by sudden acceleration. This behavior is not random, it is structural. When supply and demand balance tightly, price moves slowly. When that balance breaks, price moves fast. This is why backwardation combined with compression creates such a powerful setup, because it tells you balance is weakening, not broken yet, but weakening. And when balance weakens enough, price must move to restore equilibrium. What makes the current situation even more interesting is that this is happening while global demand trends remain strong. Industrial demand is steady, investment demand remains present, supply growth is not accelerating dramatically. This combination increases sensitivity because sensitive systems react more violently to change. Most people will continue watching headlines. They will continue reacting emotionally to daily price moves. They will continue missing the structural signals forming beneath the surface. But structure always leads price. Always. And in the next part, I am going to explain the biggest risk and the biggest opportunity created by this situation. Because backwardation does not guarantee only one outcome. It guarantees only one thing: change. Backwardation does not promise you that silver will go straight up, and this is where honesty matters more than hype, because backwardation is not a prediction, it is a condition that tells you balance is fragile, and when balance is fragile, outcomes become more extreme in both directions. Most people hear about structural stress and assume it means instant price explosions, but markets do not reward impatience. They test it, they stretch it, they create doubt before they create clarity. This is the phase where silver can still move sideways, it can still fall temporarily, it can still shake out participants who are watching only price and ignoring structure. And this is what creates the biggest risk, because fragile systems do not break on schedule, they break when pressure reaches the breaking point. And until that moment arrives, uncertainty dominates. This is why volatility is rising even before price is fully moved. The market understands something is changing, but it has not decided how fast that change will express itself. That uncertainty creates instability. It creates sharp moves in both directions. It creates an environment where confidence can disappear quickly. But inside that risk, there is also opportunity. Because structural transitions are where the largest repricing events are born, not after everyone agrees, not after headlines confirm it, before and during the period when signals exist but certainty does not. This is the moment when the market is deciding. Right now, silver is not behaving like a metal with abundant surplus supply. It is behaving like a metal where availability matters, where timing matters, where immediate ownership carries value. That is what backwardation represents. Preference for the present over the future, urgency over patience, reality over expectation. And when markets begin prioritizing present reality over future expectation, it tells you trust in future supply is weakening. Trust is the foundation of futures markets because futures contracts are promises. Promises that metal will be available later. Backwardation questions that promise not completely, not permanently, but enough to matter. This creates the environment where every new demand wave has more impact than the last one because supply buffers are thinner, because seller confidence is weaker, because buyers become more aggressive, and aggression changes price behavior, not smoothly, but abruptly. There's another important factor here that few people talk about: human psychology. When price begins moving strongly after a long period of compression, perception changes fast. People who ignored silver suddenly notice it. People who dismissed it suddenly analyze it. People who waited suddenly rush. This creates momentum. Momentum creates acceleration. Acceleration creates attention, and attention creates more momentum. This feedback loop is how markets move from quiet accumulation to public awareness. Right now, silver is still in the quiet phase, still in the structural phase, still in the phase where data matters more than headlines. Most people are not watching backwardation. Most people do not even know what it means. But that does not make it unimportant. It makes it early, and early is where structure forms. Early is where pressure builds. Early is where change begins. In the final part, I'm going to connect everything together: the structure, the history, the positioning, and the signal that ultimately determines when backwardation stops being a warning and becomes a confirmation. Everything now comes down to one moment. The moment when pressure stops hiding and starts expressing itself in price. Because backwardation, tightening inventories, rising volatility, and quiet institutional repositioning are not the end of the story. They are the preparation phase. The real confirmation only happens when the physical market forces the financial market to respond. Right now, the system is still holding together. Futures contracts are still rolling forward. Vault inventories are still functioning. Deliveries are still being fulfilled. On the surface, nothing looks broken. But beneath the surface, the balance is no longer comfortable. It is tense, it is sensitive, and sensitive systems react faster than stable ones. There is a very specific signal that experienced traders watch during this phase. It is not just backwardation itself, it is persistence. Temporary backwardation can happen during moments of stress, and then disappear. But when backwardation begins appearing repeatedly, when it begins lasting longer, when it begins spreading across multiple contract months, that is when the warning becomes confirmation. Because persistent backwardation tells you something simple and powerful: physical demand is no longer temporary, it is structural. And when physical demand becomes structural, price must eventually reprice to reflect it. This is where the paper market loses its advantage. Paper markets can influence perception, they can influence short-term movement, but they cannot manufacture physical supply. They cannot deliver metal that does not exist. And when enough participants begin demanding real metal instead of paper exposure, the balance of power shifts. This does not happen overnight. It happens gradually, and then suddenly, first small spreads tighten, then spot strengthens, then futures adjust, then volatility expands, then price accelerates. Each step builds on the last. Each signal reinforces the next until the market reaches a new equilibrium. Right now, silver is somewhere in the middle of that process. Not at the beginning, not at the end, but in the transition phase where the signals are visible to those who understand what to look for. What makes this moment so important is that transitions define cycles. Most of the time, markets operate inside established ranges, predictable ranges of comfortable ranges. But transitions are when those ranges break, when the old assumptions stop working, and when new pricing structures begin forming. Backwardation is one of the earliest structural signs of that transition, not a guarantee, not a promise, a signal that the relationship between supply, demand, and trust is changing. And once that relationship changes, everything else follows. Price, volatility, sentiment, participation, everything. The market will decide its timeline. It always does. It will move when pressure becomes too great to ignore. It will resolve when imbalance reaches its limit. But the signal is already there. The structure is already shifting. The question is no longer whether backwardation has appeared. It has, the real question now is what happens next. Because when silver begins prioritizing the present over the future, history shows the future rarely stays quiet for long.